Hi, wanted to give you an explanation of essential question number 1 that was given on November 9th in the fall of 2011. So let's start off with your first element, which is you're running an apparel company. Okay, so you hire 3 designers to start a new line of men's denim released in the fall. I think the key phrase here is you hired 3 designers. That looks like to be an expense. And remember, anytime you have, things going on in the income statement, they'll have an effect on net income pretty much. And so we see net income going down. Things on the income statement echo over to cash from operations. So net income goes down, cash from operations goes down. It's kind of the explanation of question number 1. So let's go ahead and get to question number 2. We'll switch to blue for this one. Buy two new sewing machines for making patterns. Well, you get one kind of asset, which is a sewing machine. It's a fixed asset. In exchange, you got rid of some cash. So the balance sheet balanced itself out, all just in the asset category. No big deal. Now remember, purchasing and sale of assets is the kind of thing that gets reflected in the cash flow statement, and it's get reflected in cash from investments. So you should also see a decrease in cash from investments over here, and that should give you a pretty good answer to question 2. Let's go to 3. And this one will be in that color orange right there. Take out a small loan, has some cash on hand. Here's what we're doing is we're getting some cash. We took out a loan, but at the same time the loan's a liability. Remember, owner equities plus liabilities are supposed to equal to assets, and you should be A-OK. There's also an echo from the balance sheet over into the cash flow statement. Basically, borrowing lending is supposed to be reflected in finance. So we had an increase in cash from finance. Remember, the cash flow statement is watching sinks and sources. So whenever the company gets more cash, there's a positive number. Whenever it gets less cash, there's a negative number. So let's go ahead and switch to yellow for the next one. Robbery. Costs you $5,000 stolen materials and inventory. Okay. Here's what it is we'll catch this a couple of different ways because of different rules that you know. One, you can think of it as an increase in expense, which gives you a decrease in net income, which gives you a decrease in operation. So that's one of those acceptable ones. Other one is you can say, oh, I've had this robbery, so I've got this assets that decrease. Well, that's a decrease in owner equity. And, it's presuming there was kind of a replacement that was going on here with the expense. So I think either one of those two will generally work for you as far as the correct answer goes. So let's go ahead and switch to purple for the next one. Customer pays for his order of 12,000 units up front. You have 30 days to fill the order. Hey, that's pretty sweet. First off, let's handle the balance sheet things. What you have here is both an increase in cash, because they paid ahead of time, and there's also an increase in liabilities. What you have here is prepaid anything. And prepaid anything in that sense is a liability. You owe somebody else money. And what this is going to be is basically the person buying from you is extending you a loan. So you're going to see this as an increase in cash from finance. So I'm pretty good with that part. You can also catch the part over here, which is revenue, if you're actually recognizing it right now. And that will eventually become an increase in net income and an increase in cash from operations. This is one of those ugly ones. I kind of expect you to get this part. This one is the other one that you may get, but I'm expecting the balance sheet thing to be a little bit more likely. Let's go ahead and get to green for a little bit to make a payment on a loan. Now, if this was a zero interest loan, the way you see it is there'd be a decrease in cash because of those payments that you're making. Cash is going away. And there's also going to be a decrease in liabilities, and that's the balance sheet part. Please note the balance sheet balances. And you'd see a decrease in cash from finance. But if this thing had some interest on it, well, then you've got this interest expense that's over here that makes your net income goes down. And that gets echoed into cash from operations. So it all ends up being, I expect you to get the balance sheet side of it, and this income part is just a complication I don't want to quite go through yet, but some of you will have it, and it'll probably be a correct answer too. Let's go ahead and move on to the next question, which is sell some old equipment. And I have no idea what that color is. It's like blue or green or something along those lines. And what we're doing here is getting rid of some equipment. So there's a decrease in fixed assets, and we're getting an increase in current assets in return. The current is the cash. And so what we have here is a source of cash coming in. And so there's an increase in cash from investments. And then finally we've got this one that's a little bit complicated. It says borrow, and that's the part that should throw you just a little bit. So we'll go ahead and do that one in black. So there's a couple of ways of thinking about this one. One, you kind of ignore the borrow part. If you ignore the borrow part and you say, oh, you take 500 for personal use. Well, your cash goes down, your owner equity goes down because they got a balance, and your cash from finance goes down. Now, the other thing is if we take this borrow part seriously, you're actually just lending money to somebody, it just happens to be the owner. In which case, what you have is the cash goes down. You take on an additional liability, additional asset, which is that loan that the other person owes you. And here's the funny part. So it balances out up there. Here's the funny part. You actually have a decrease in cash from finance, and this will kind of creep its way up as the owner pays you back. So again, there's a couple of ways of handling it. Either way is going to go ahead and work for us, whether you take that borrow seriously or not. Anyway, so here's the answer to essential question number 1, given on November 11th in the fall of 2009.